Welcome to the Red Cloud Research Roundup, hosted by Red Cloud Financial Services. It is May 6th. In a unanimous vote, the U.S. Senate recently passed a bill banning Russian uranium imports, being sent to President Biden for final sign-off. In addition, uranium producer Peninsula Energy has been deemed a worthy story to the Red Cloud Research team, having recently initiated coverage. Managing Director and Head of Equity Research David Talbot is here to provide details on the news. So with that, David, over to you.
Thank you for that introduction, and welcome to episode 67 of Red Cloud Securities Research Roundup podcast. I'm David Talbot, Managing Director and Head of Research here at Red Cloud Securities, and I'm pleased to join you today as part of an ongoing series of discussions with the Red Cloud Research team. There are two things I'd like to speak to you today. We recently launched on Peninsula Energy, PEN, on the ASX with a buy and 25-cent Aussie target price. But first, I'd like to discuss last week's major news out of Washington, D.C. that will impact the uranium and nuclear industry in the U.S. and elsewhere. The U.S. Senate finally voted and unanimously passed the Prohibiting Russian Uranium Imports Act. The House had passed the bill in December 2023, and in response, uranium prices rose quickly from $65 to $91 between September and year-end of 2023. This legislation now heads to the White House, where it's expected that Biden will sign it into law. And this act will work quickly. It will bar imports of Russian uranium into the U.S. within 90 days after signing. Although the Department of Energy would allow temporary waivers until January 2028, if necessary for nuclear utilities. It remains uncertain how strict the DOE will be in upholding the uranium ban, and the legislation has been coming for a couple years, but it does take 1 or 2 years for nuclear fuel to typically work its way from uranium to usable fuel pellets. It is possible that now all utilities will not get the uranium they require, whether in the US or elsewhere around the world. Now, uranium isn't scarce, but it is challenging to develop, permit, and produce, and it is very price dependent. Conversion likely isn't the problem. The world has about 42,000 tons of uranium conversion capacity, with about half of that coming from Canada, the US, and France, and the rest is from China and Russia. Enrichment, though, might be the trouble spot. In 2022, Russia had capacity of over 27,000 tons, and China had capacity of about 9,000 tons of the 62,000 tons of enrichment capacity globally. So that leaves the US and France with about 23,000 tons capacity, and most global ramp up in the next few years coming from China. Yes, we will see some European and US enrichment capacity growth, but it's minor and will likely need more, at least to ensure that the West can have suitable nuclear fuel supplies. The Russian uranium import ban is big news. Russia provides about 1/4 of the enriched uranium to the US nuclear fleet. That fleet is 90 reactors in size, which use close to 50 million pounds per year, according to the US Energy Information Administration. The U.S. is the largest consumer of uranium, and Russia was its largest provider, and those sales totaled almost $1 billion per year to Russia. A Section 232 review looking at the nuclear fuel industry did take place a few years ago and came to the conclusion, and that's a bipartisan conclusion, that from an energy and national security point of view, the U.S. had become way too dependent on foreign uranium. Specifically, 40% of that came from Russia and its close allies, Kazakhstan and Uzbekistan. But the invasion of Ukraine took things to a whole new level. And while coal, oil, and natural gas imports were banned almost immediately, it has taken much longer to halt Russian uranium and enrichment, given that it has supplied a large proportion of the industry, which produces about 20% of American electricity. Assuming that Biden signs this act, the immediate risk becomes whether Russia counteracts. It has been noted that Russia is starting to respond more quickly. When its assets were frozen recently, Russia quickly moved to seize assets in Russia of JP Morgan, which is the largest US bank. This quick measure did come with some surprise to some, if not impressed China, according to some media articles. Now, regardless, replacing the uranium and even more importantly, the enrichment services will be a challenge for the Americans, and it will likely have long lasting impacts. Ultimately, we believe Russian and likely Kazakh fuel could stay in Russia, China, and perhaps India as it ramps up over the next couple of decades. And this is likely to drive prices higher. The U.S. nuclear utilities will likely get support from friendly uranium producing jurisdictions such as Canada, Australia, Niger, although that final country has some issues of its own. And prices are going to rise up. So, already at $92 a pound now, we do see incentive for U.S. uranium producers to start producing uranium in the U.S. Right now, we are seeing past producers re-enter production or move new production forward, mostly in Wyoming, Texas, and Utah. And this is positive news. With uranium prices near or over $100, we believe this certainly should help North American production grow. Uranium companies aren't necessarily looking for other handouts from Washington. They simply believe that market pressures will allow them to ramp up production as long as they weren't being undercut by state-owned entities dumping subsidized uranium into its own backyard. So this is all good news for the sector. We will closely watch and see how this plays out, but we do expect more mainstream media coverage on this as well. And that will likely bring more investment to the sector, including new investors. And that should help fund some of the new production that we should see in the coming months to years. Right on cue, we'd like to focus on one of those companies looking to ramp up U.S. uranium production starting by year-end 2024. Red Cloud recently launched coverage of Peninsula Energy with a buy rating and 25-cent Aussie target price. So this is PEN on the ASX. Now, Peninsula is a banking client, and we've been to site 2 or 3 times over the past 12 years or so. Peninsula has near-term uranium production potential at its Lance ISR mine in the prolific Powder River Basin of Wyoming. Now, unexpectedly reverting from toll milling last year caused a production delay of a little over a year, and it had necessitated additional capital funding as they had to expand the ISR plant sooner than anticipated and before production began without the help of cash flow. That said, going it alone helped de-risk the project by accelerating ISR plant expansion and over doubling initial production rates from about 820,000 pounds per year to almost 2 million pounds per year certainly is going to help. Essentially, they skipped an expansion step when they suddenly had the time. Now, only one more expansion will be needed to get to the 3 million ton per year rate. And this project easily has the resources and the upside to support that. This production delay also allowed time to sink a new and improved well field. This means new wells start out at maximum recoveries and don't need to be reverted from high pH, saving both time and acid. This should provide improved efficiencies, help expand production, and puts control in Peninsula's hands much sooner. Management guides that construction remains on track, and they're largely cashed up for the initial production by year-end 2024. Its large resource base and considerable upside, as I said, will likely support further expansion towards its existing license capacity of 3 million pounds of uranium per year, making this one of the largest U.S. ISR producers, if not one of the largest uranium producers in the U.S. In Wyoming, only Cameco's 2 long-closed ISR plants, Smith Ranch Highland, combined for a license capacity of 5.5 million pounds, but those don't necessarily have the resources. All the others right now have less capacity. Uranium Energy has about 2.5 million pounds. UR and Energy Fuels both have 2 million pounds in Wyoming. Only UR Energy's Lost Creek is currently operational. So let's get into it a little bit. ISR is cheap and environmentally friendly. About 60% of uranium production globally is via ISR. It has a small footprint and little surface impact with no digging or tails. Wyoming is the most productive U.S. uranium jurisdiction. In NRC agreement state, it has about 15 million pounds of licensed annual capacity and has led uranium production since 1995. Lance, as I said before, is located in the prolific Powder River Basin, and that's near other uranium producers. We expect large, long-life ISR production from Lance. It's one of the largest projects with considerable upside. It hosts about 54 million pounds of uranium and is licensed for 3 million pounds per year. Lance has several sandstone-hosted uranium deposits amenable to ISR production. The Ross production area hosts almost 6 million pounds and has 2 prior mine units with potential for 2 or 3 more. The Kendrick area hosts almost 16 million pounds and needs amendments to the Ross production license and typical wellfield permitting. The Barber exploration area hosts 32 million pounds of mainly inferred resources. Now, Barber isn't included in the company's technical studies, but we have incorporated it into our DCF model. And the 7 million pound Dagger project is located 20 kilometers away and should make a good satellite project. We see significant resource expansion potential. While resources already total an impressive 54 million pounds, only limited drilling has been completed outside the tiny Ross and Kendrick areas of this large 8-kilometer by 37-kilometer project. Management suggests an exploration target of between 100 and 160 million pounds of additional uranium, grades low to modest, let's say 426 to 530 ppm, but we aren't really concerned about lower grade ISR projects as long as porosity and permeability are good. Now, a 2023 life of mine update outlines strong economics for the project. It contemplated a low pH ISR operation over a 10-year life of mine using just 22 million pounds to support expanded production of between 1.6 and 1.8 million pounds per year. All-in sustaining costs here about $42.50 per pound. Positive project economics suggest an NPV of about 116 million, IRR of 26%, and 3.5-year payback. Now, using acid leach isn't typical in the US, but that is the way it's done in Kazakhstan, Uzbekistan, and Australia. The decision was made to go this route really due to challenge recoveries using the alkali leach that's been used in the US in the past. Near-term production is expected, with production due by year-end. Plant construction was to begin in April, and wellfield installation is already underway. Guidance remains that Lance is on track for production by the end of the year. Mostly funded to initial production, free cash flow is anticipated by the third quarter of 2025. Now, the company's got about 50 million in cash in hand. In the money warrants and existing uranium inventory at the end of March. Peninsula should be able to cover most of the remaining initial capital through first production. Pre-production capex did creep up about 20 million bucks recently, but funding through positive free cash flow by the third quarter of next year really just increased by about 5 million bucks to about $100 million. Higher uranium prices really help offset these requirements by increasing the value of existing uranium inventory and initial cash flow. So we do estimate the Peninsula might have to seek an additional 50 million bucks. They're likely going to do a non-dilutive funding to help support the ramp-up phase, likely debt or U.S. government support. The company does have strong offtakes. That provides visibility and revenue stability. They have 6 offtakes for about 6 million pounds of uranium, and that covers about 40% of life of mine production between 2025 and 2033. Now, management does have exceptional experience in ISR exploration, development, mining, rehab, offtakes, funding, and capital markets. The CEO, Wayne Hiley, has about 30 years experience, mostly in the uranium industry, and he helped design, build, and operate UR Energy's Lost Creek mine in Wyoming, which, in my opinion, is the Cadillac of ISR uranium plants. Positive nuclear power trends, those are clearly visible. Nuclear capacity growth is higher than anticipated. Uranium production still can't meet demand. Uranium production is very concentrated. The Niger coup brings all eyes on the US for uranium supply. We did talk about the Russian import ban here a little bit earlier. And really, supply-demand factors really drove that uranium price rally last year where prices almost doubled. U.S. government support certainly is going to provide a strong tailwind for domestic production. So, with our initiation of Peninsula with the buy rating, 25-cent per share Aussie target price. Our target's based on a 0.9 times multiple, 8% DCF for Lance, and an in situ valuation for Dagger. We're using, let's say, $2.50 a pound US for Dagger. Our assumptions, they're based on the life of mine update with production starting from Ross in late 2024, uranium deliveries into the second quarter of next year. And we also then assume an expansion of 3 million pounds around 2023 from the Barber area, making this the largest ISR project in the US. Upcoming catalysts, there's a lot of them for investors out there. First of all, plant expansion work was to begin in April. Construction contractor was appointed earlier in the month. They're doing resource drilling at Ross, Kendrick, and Dagger in the second quarter of this year. Mine unit number 3 is underway. The header house installation is expected in the third quarter. They expect additional funding to cover the ramp up and the end of the initial build. So, like we said, 50 million pounds of debt, maybe from the US government grants as well, probably the third quarter. Wellfield preconditioning in the third quarter this year. And then, as we said, production by year end, deliveries in the second quarter of next year, and projected positive free cash flow in the third quarter of 2025. So mining exploration, inherently risky. Peninsula is subject to the usual geopolitical, technical, corporate, financial risks that you see for most uranium companies. We do understand people's frustrations on this one, partly out of their own control, getting things up and running last summer. I do think they have a well thought out pivot, which really should make this company a lot stronger once production begins. We have visited site here over the last 12 years about 3 times. Known management since 2008, specifically Wayne Hiley, as he was helped building the Lost Creek mine, also in Wyoming. So why don't we leave it at that? Quite exciting times again in the uranium sector. Uranium prices rebounded back up to $62 a pound from $91 a pound at year end 23. And with the need for U.S. utilities to find other sources of uranium, non-Russian, Peninsula's construction and ramp up is really coming at the right time. So thank you for supporting Red Cloud Securities podcast.
Thanks for listening to the Red Cloud Research Roundup podcast. We hope you enjoyed this dive into recent notable mining news. Remember, you can join us every Monday for new episodes. And as always, you can head over to redcloudsecurities.com to read all our research reports discussed, for all Red Cloud Securities free research reports, and to sign up to our email list. That's it for this episode, and see you next time.